Hello, everyone. Thank you for making the choice to invest in yourself and your practice by joining today's CE-accredited financial planning session, How to Help 3 Client Goal Types Efficiently. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague, Steve Arnott, Snap's Financial Planning Project Lead, who will provide today's demonstration and run the Q&A. You must stay for the full session today in order to be eligible for your CE credit. Shortly after the session, about 1 hour after, you will receive a brief form to fill out via email, which is how you will request your official certificate from today. Before we get started, I'd like to do a quick tech check to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your question tab? Just click the arrow beside the word question and a window will pop up where you can type and hit send. That's exactly how you'll send any questions you have throughout the session. Oh, wonderful, thank you. Max, Jennifer, Nicole, Tracy, Christopher, Kelly. I can see a ton of these coming in. Thank you so much. And again, thank you all for being here live with us today. So Steve and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. So for those of you who aren't already familiar with Snap Projections, Snap is a Canadian financial planning software platform and part of the CI family. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you're wondering what other advisors have to say after using SNAP projections, or how we might compare to other solutions you may have tried or currently be using, you don't need to look any further than the reviews page on our website. Thousands of Canadian advisors are already using SNAP projections to provide financial planning for their clients and grow their practices. If you're wondering about SNAP, asking your colleagues who are already using it is a great place to start. You can also find out more about what current users of the software have to say on Capterra, which is a third-party software review platform. We're currently sitting at 4.9 out of 5 stars, with recent reviewers saying things like, Snap is foundational to our firm, and none of our clients retire without a Snap projection. You can click to the Capterra website from our reviews page on the SNAP website if you'd like to read through those and also see where other advisors came to SNAP projections from. So our session today is going to tackle a challenge many advisors are dealing with, and that's how to remain efficient when clients have drastically different planning goals and concerns. We're going to take a different approach for today's session. Typically, we focus on addressing client questions, but today we're going to focus on client goal types. You are going to see how 3 highly individualized cases can be built and assessed. The 3 cases covered today will include a client with no clear goal. They're concerned about sustainable cash flow throughout retirement and are essentially just seeking peace of mind. Next, a client with a specific spending target. Are they on track to meet their cash flow goal? And if not, what can we do now to change that? Third, we have a couple with a specific life event goal. They would like to purchase their first home, and they're wondering if the new first home savings account might help. We're going to focus on 3 simple plans, and you will witness each built from end to end, providing you with actionable strategies to address these planning needs for your own clients as well as prospects. You may be wondering how it's possible to remain efficient while providing highly personalized planning to multiple clients. And it's possible because Snap is a financial planning software that was designed with advisors for advisors. We believe there are four core elements that are absolute essentials for any good financial planning software. Number one is transparency. When you need to explain something to your clients, you need to first be able to understand it yourself. I talk with advisors all the time who tell me that if they cannot see how the numbers are being calculated, they feel uncomfortable presenting the plan to their clients. Next comes flexibility, customization, and control. Without that, you can't model your clients' lives accurately or make the plans truly personal. Good financial planning software should also be easy to learn and easy to use. Lack of ease of use is one of the biggest barriers to software adoption. If it's hard to use or the learning curve is steep, no one wants it. Last, but certainly not least, comes customer support and service. If you're not using Snap, I'd encourage you to ask your colleagues what their experience working with our team has been like, and I'd also encourage you to compare these response times with your current provider. So what you're about to see here as I hand this over to Steve is that Snap will show you where the numbers are coming from. You'll see how much flexibility and control you have within the software and how straightforward learning to use the program will be. To run a simple projection and answer some basic questions, we just need to enter a few data points. Name, date of birth, province of residence, income, current asset holdings, and any planned contributions. That's it. This is one of the key elements that sets Snap apart from other financial planning software. Many advisors use it live during prospect meetings to quickly create simple plans that prove the value of working together within 5 to 10 minutes. So I'll get Steve to take over now and log into Snap.
Terrific. Thanks so much, Alex. And thank you again, everyone, for joining us today. Snap Projections is a web-based platform, which means that you can access your account from any Chrome browser on any computer without the need for a download. You'll go to snapprojections.com, and then in the top right corner, you can click Login to enter your username, password, and you'll have the option to enable a multi-factor authentication for added security. I've input all of that during today's session, so I'll click Login and go directly into the software. I land initially on my clients page where I can view and access any of the projections that I've created in the past, or I can click Add New Client in order to get started on a new plan. As Alex mentioned, we're going to be looking at 3 different client files today to show you how Snap can be used depending on the type of client situation you're dealing with. Sometimes a client will come into your office or you'll ask to meet with a client who has no clear goal that they're looking to work towards. They just want a general sense of where they're headed and what they should be considering along the way. And that's what we're going to be doing to start with. So our first projection is going to be for a client who doesn't have a specific budget or savings goal in mind. All that they're looking to do is confirm whether they're on, what they would need to do in order to be on track to retire as early as age 60. So we'll go back into Snap and we'll start entering in the information for our client, whose name is Carl DeMello. He was born in 1990 and currently lives in Alberta. In the top left section of the software, you'll see that there are 3 key areas to the tool. The first is the scenario setup. These are the input pages that we'll progress through shortly, where we can set things like the general plan settings, our client's expenses, incomes, assets, and more. Once we're done entering the base client data, we'll then proceed to the planning pages, where all of that information will come together to show us Carl's life on one single page. From here, we can review the client's information, make edits to any 1-year value, or to adjust the plan over specific periods of time. When we're comfortable with all of the numbers, we can then proceed to the client report, where we can select what charts, tables, and commentary we would like to include in a final client-facing document. For now, we'll continue on through the scenario setup. I'll click Next at the bottom, and we'll go to the General Settings page. We're going to begin the projection as of 2024, and as we mentioned, Carl's just looking to make sure that he doesn't need to work past age 60. So whatever plan we put in place, he wants to ensure that that is not dependent on further income after he turns 60. We'll run the projection until age 100, and then we'll use the default FP Canada guidelines for inflation. And we've also adjusted our default rates of return to reduce those from the standard FP Canada guidelines down to a reduced net of fee figure, factoring in any expected management fees. We've then saved these defaults for all future projections, so they're pre-filled when we create a new plan. So we'll use 1, 2, and 5%. I'll click next and go to the expenses page. Now, SNAP has an incredible amount of flexibility when it comes to planning for expenses. Some clients will have meticulous budget that they're following and they want to be able to see those details in the plan. And we have the ability to enter in either gross budgets or you can itemize expenses for any specific period of the plan. We also have the ability for SNAP to calculate the client's budget and to let them know what their discretionary cash flow is and to tell them what a sustainable spending level would be given their resources. So you can input the numbers if you have them, or we can leave them blank and have SNAP help us to calculate them later on. And that's what we'll be doing for Carl. I'll leave this page blank and we'll proceed to the incomes section of the scenario setup. Currently, Carl is earning a total of $120,000 a year, so I'll update the amount here. And we can set a custom indexing assumption for that income. So as a conservative default, SNAP starts at 0. We could enter in any other percentage that we and the client are comfortable with. Or if we clear the value altogether, we can link that directly to the general inflation rate in our projection. This is being input as employment income, so SNAP will automatically deduct CPP and EI premiums. It will also tax it appropriately, and then it will earn and track RSP room going forward. It's going to begin in the first year of the plan, and we could customize this if a client was planning to transition careers and start a new income in a future year. We can customize that. And then it's also going to stop at the end of the year before they retire. If we want, we can click on this gear symbol in order to prorate that income to a specific retirement date if a client is going to work partway through the next year. We can add other incomes to the plan. For instance, if Carl had a rental property, we could add that here. And we could also add defined benefit pension plans with or without a bridge benefit. I'll click next and go to the assets page where we can enter in Carl's current accounts. You'll see that under the financial assets section, SNAP adds a default non-registered account to the plan. And this simply serves as a location where SNAP can allocate any future surplus into a financial asset. So it starts with a 0 balance, and if there's ever a surplus in a future year, SNAP can allocate that towards the financial assets. In this case, we're just going to update the description to future investments. We're going to leave the value as 0 as Carl doesn't currently have a non-registered account. And we're going to adjust the asset allocation to 30% fixed income and 70% equity. And we can see that SNAP has already pre-filled our asset-based rate of return values. So 1%, 2%, and 5%. And then it's given us a total portfolio return based off of the asset allocation that we've selected. On an account by account basis, I could customize this rate of return for any of the assets. So if I think that this account is going to earn a higher equity return than my general default, I can customize that as needed. Next, we'll enter in his other account balances. So right now he has $70,000 invested in a tax-free savings, invested as 30% and 70%, and he has an RSP with $90,000. Over top of the table of accounts that we've now input, you'll see that there are tabs for each of the registered account types. If I click TFSA, you can see that I can now customize the assumed contribution room for the first year of the projection. This is a common theme throughout the SNAP software. We default a lot of the assumptions and settings to conservative starting points so that you can create a simple projection quite quickly. But we also allow you to come into these settings and customize them in order to really tailor the plan to your client's unique circumstances as needed. So in this case, Carl has 20,000 of TFSA contribution room as of this year, so we'll update that here. Similarly, I'll update his RSP contribution room to 30,000 And you'll see that there are other settings that we can customize as needed. We can change the conversion age of moving the RSP into a RIF. We can base the minimum withdrawals off of a younger spouse and so forth. Now that we're done adjusting the contribution room for those two accounts, I'll scroll down to the real assets section and click add real asset. And this will allow us to enter in his home that has a current value of 500,000 and an original cost of 400,000. Again, we can customize the appreciation rate, which defaults to the inflation value in our projection. If we wanted to, we could purchase a property in a future year, or we could sell a property if a client's going to downsize or sell their home later in retirement, for instance. And we can indicate whether there are capital gains taxes applicable to the transaction. I'll click next and we'll go to the debts page where we can enter in Carl's mortgage, which has a current balance of 250,000, an interest rate of 5%, and a monthly payment of 1,800. We can link the mortgage to the home so that if we sell the home at any time in the plan, if the mortgage has not yet been repaid, it'll be repaid at that time automatically. Next, we can go to the government benefits page. You have lots of flexibility to customize these values as needed. So you can change the start year that the CPP is going to begin. As a default, SNAP begins CPP as of the client's retirement or as soon as available thereafter. I'm going to change that back to 65. It also assumes the national average CPP benefit, which is 55% of the maximum, and I'm going to increase that to an expected value of 75%. So you can always input either a dollar amount if the client is currently receiving CPP or they have a Service of Canada statement, or you can enter an estimated percentage of maximum. For old age security, we're going to begin that as of age 65 with an expected 100% value. And just like that, in about 10 minutes, we've been able to input all of Carl's data that we need to for this projection. You'll see on the left that there are additional scenario setup pages available. So we could add life insurance if required. We could conduct life needs analysis to see if more insurance may be required. We could add an RESP or customize additional settings in the plan. And then of course we can add a corporation if applicable. But for this plan, we're all set with the input and we're ready to click on planning pages and see how all of this information can come together to show us Carl's life on one page. Now, as you land on the planning page, it can seem overwhelming the first time you see it, but once you know what you're looking at, it's incredibly intuitive and a very powerful section of the software. On the left-hand side, you have the year and your client's age. You then have the calculated discretionary cash flow that is available for use outside of the projection. So SNAP is taking the 120,000 of employment income. It's subtracting off the CPP and EI deductions, subtracting off the taxes payable, and subtracting off the mortgage amount of 21,600 per year. And that leaves Carl with roughly 65,441 available for spending purposes outside of the projection. As we continue down towards retirement, we can see that SNAP is continually updating the annual discretionary cash flow available until the point that we're projecting him to retire at age 60. And as a default in SNAP, that's when the software allows us to set a target spending level. So if Carl wants 50,000 a year or 60,000 a year, we could click on this 0 and input the total annual spending need that he wants. We could also use the software, its recommendation engine, to help us calculate what a sustainable spending level would be for him starting at retirement. In addition to using SNAP to help calculate the level of spending that would be achievable, we can also change the timing that we want to set a target spending. So if I want, I can come back up to the first year of the plan and turn on the target spending as of age 34. And now, rather than assuming that everything is getting spent each year, I'll be able to set a target spending and assume that any surplus cash flow is going to be saved automatically into Carl's investments. Now that I've done that, I'll go to the recommendations tool and we'll use the sustainable spending calculator to determine what a consistent lifestyle level would be that Carl could achieve starting this year all the way until the final year of the projection. So SNAP has quickly calculated that if he were to spend $53,635 per year, this is an after-tax real dollar amount, so it'll be adjusted each year for inflation. That is going to allow him to smooth his lifestyle out throughout the entire projection. So now we've populated the target spending with $53,635. If we scroll to the right to the financial assets section, we can see that SNAP is automatically contributing the surplus into his RRSPs. As we continue down into the working years, we can see that eventually SNAP catches up on that 30,000 of carry forward room, and now it's starting to contribute both to the RSP and the TFSA. Then once the mortgage is repaid at age 51, there's some additional cash flow now available, and so it starts making increased payments to the TFSA. And then in the final year of work, we can see that it's maxed out the TFSA, the RSP, and it's made its first contribution to the non-registered. On the left, we can see all throughout that period, the same level of spending, $53,635, has been maintained, and SNAP is simply indexing that number for the actual amount of spending that is being done each year of the projection. Then at age 60, we have retirement. We can see the employment income ends, and now SNAP is going to calculate where to take the money from in order to meet the client's spending need. So it's taking a withdrawal from the non-reg, it's depleting the TFSA in addition to the RSP assets. Then once the CPP and OAS kick in, we can see that it's pairing that with TFSA withdrawals. And then once the RIF turns into, or once the client runs out of TFSA, it reverts to the RSP and starts drawing down on those assets all throughout the remainder of the projection. And in the final year, it leaves the plan with $300 in order to create a sustainable projection. We can also review this plan in the form of charts. So if I click charts in the top right corner, we have the cash outflows. So this is showing where the client's money is going each year of the plan. This base expense figure is that 53,000 annual spending being indexed for inflation. Next, we have the income taxes payable each year. We have the mortgage payments, and then we have a gradually increasing amount going to financial assets as the client's income indexes, and then once their mortgage is paid off. Scrolling down to the cash inflows, we can see the employment income. And then in retirement, it's going to be a combination of withdrawals from investments plus his CPP and OAS. And then we have the net worth that results from all of those transactions. And we can see everything building up to age 60 and then a gradual drawdown on the financial assets into the last year of the plan. And all of these charts are fully interactive, so I can disable any of the sections in order to focus the conversation on one particular area of the client's finances. So here I just have a liquid net worth illustration of what the client's numbers would look like over time. So going back to our list of 3 client profiles, we've been able to tackle the first use case, which is a client with no clear goal. They aren't saving anything specific today. They're just kind of, every time that they have more money than they need, they put it away. They're not sure whether they're saving too much or too little. What we've been able to do is give them a very clear indication of how much they would need to save each year going forward in order to maintain a consistent lifestyle without much variation over time. The next thing that we're going to do is to help a client who does have a specific spending target. So in this case, the client wants to know whether they're on track to meet that, and if they're not, what can they do in order to get on track? So we'll go back to SNAP projections, we'll go to clients, and then we're going to click add new client to create a new projection. In this case, we're going to work with someone who is 10 years away from retirement, who's wondering if they're on track for their goal to retire at age 65 with a target spending of $60,000 per year in retirement. If they're not on track, they'd like to know what their options are moving forward. Our client's name is Diana Campbell. They were born 1969 and currently live in British Columbia. I'll click next and we'll go to the general settings page. Here again, we'll start the projection this year with a target retirement this time of 65 and a projection length until age 100. We'll use the same inflation rates and our pre-populated default rate of return assumptions. I'll click next and go to expenses. This time, because we have a target expense level in mind, I can actually enter that here. So it's going to be $60,000 starting from retirement in today's dollars after taxes. So that's been input and that'll reflect once we move to the planning pages. I'll click next and go to incomes. Diana is currently earning $140,000 per year. And we'll once again assume that that's going to index with the general inflation rate. It's being input as employment, taxable, RSP eligible, with an end date at the end of the year that she turns 64. She also has a defined benefit pension plan from a previous employer, and that's expected to start paying when she retires at age 65. So there's no value before age 65, which is typically used if there's a pre-age 65 amount, and that might include a bridge benefit. But in this case, it's just going to be $25,000 a year with an expected 1% annual indexing. I'll click next and go to the assets page. Once again, the default non-registered has been added. In this case, I'm going to delete that account because we do have an existing non-registered account for Diana that we can input. So I'll get started by adding her TFSA, which has a current value of 90,000, an allocation of 40% fixed income, 60% equity. She also has a personal RSP with 240,000 and a group RSP for her current employer with $40,000. And then finally, she has a non-reg with 50,000, similarly invested in a balanced portfolio. We can go to the registered account tabs to adjust the TFSA. So in this case, she's made contributions for all previous years. So we'll leave the 7,000 available for 2024. On the RSP tab, we'll adjust her carry forward room to 50,000 based on her most recent notice of assessment. We'll then also go to the employer matching tab where we can automatically contribute a percentage of her income into her group RSP. So you'll see we have all of her financial assets. We can select which one is linked to her employment income, and then we can enter in a percentage from her and a percentage from her employer. And these will be automatically calculated and contributed to the account on the planning page. Now we can go down to the real assets and input her home, which has a current value of 650,000 and a cost base of 400,000. Once again, you can see we have the option to do a future purchase age, sale age, and adjust the capital gain tax assumption. I'll click next and go to the mortgage input. Current value of 150,000, interest rate of 5%, and monthly payments of 1,600. And finally, we'll go to the government benefits tab where we can adjust the default assumptions. So we'll leave the start age as 65, but we're going to increase the expected percentage of maximum up to 80% based off of her employment history and income level. We'll leave OAS at 65% with 100% expected benefit. Again, we have additional pages available as needed for your projections, but in this case, we're going to go straight to the planning pages and enter in a few final adjustments to the plan. So now we can view the planning page. We have current year and our client's current age. We can see the calculated discretionary cash flow that Diana has available each year of the plan. And that again is taking the 140,000 employment income, subtracting off CPP-EI, subtracting off taxes, subtracting off her 7,000 a year of employee contributions, and subtracting off her mortgage payments. So once again, as we saw in the last case, we have the option of having SNAP calculate the total spending or setting a target spending and assuming that any surplus is saved and any shortfall is going to be met through withdrawals. In this case, we're going to leave the calculated values in place, and then we have our target spending of 60,000 a year being indexed for inflation from the first year of retirement. And we can see SNAP has the pension of $25,000. It has her CPP and OAS amounts, and then it's making withdrawals out of the various investments, starting with the non-reg, continuing on to the TFSA, and then eventually using the RIF minimums. As we continue on into retirement, we can see that eventually, as of age 93, she's projected to run out of her financial assets. So we can see this pink shading on the planning page, and if we scroll all the way to the left, we can see the total annual shortfall that's being projected. And we can also see the cumulative total that she would be short if she were to borrow that amount each year on an ongoing basis. So while she is short, this 486,000 projected shortfall is fairly small relative to the expected value of her home at that point in the plan. So it's possible that Diana could be comfortable with this series of numbers and just know that she'll either downsize or do a reverse mortgage or something to meet those final few years of spending needs if she were to live this long. Now, some clients might be comfortable with that. In Diana's case, she is hoping to adjust the plan so that just her financial assets alone will be able to meet her needs. And that way she can have the home as a worst case scenario or leave that to her estate. And so we can use this recommendations tool to offer Diana some options to bring her plan into a fully funded status. So right now, within the recommendations tool, we can see that she's currently underfunded by that $486,000 figure. And we have some ways that SNAP can calculate to avoid this shortfall. So the first option would be changing her retirement age. So SNAP will calculate how much longer she would need to work in order to avoid the shortfall. So in this case, that's 2 years of delay. And if we wanted to, we could actually click apply and run, and SNAP would update the projection and apply that change to show the new numbers. We also have the option to copy this scenario before applying the change so that you have the original plan with a 65-year or age retirement, and then a new plan where it's been changed to 67. Another option is that we could change her target spending. So rather than spending $60,000 a year, if she reduced that target to $56,000, then that would help her avoid the shortfall that's being projected. And the final option would be to add additional savings. So she could either do that as a lump sum today. Let's say she was selling her business or a cottage. She could determine how much she needs to deposit today or how much she needs to deposit on an ongoing annual basis. So in this case, if she were to save $15,000 additional gross each year, she would be able to fill that gap. So I'm going to click apply and run, and we can see those additional contributions being made in the plan. So now if I look at the cash flow management savings, there's a total net of tax cash flow impact each year and the total amount being contributed to the client's investments. So the RSP contributions and the additional TFSA contributions. And as a result of those contributions, as we scroll down in retirement, we can see that there's no longer any shortfall projected. So in the final year, there's still about $800 remaining in the investments. If we go to charts again, we can see the breakout of cash outflows, so where her money is going each year. We can see where her money is coming from. And then we can see the net worth chart. So again, removing the real asset, we can see that her financial assets are projected to last until the final year of the plan. Now, SNAP is using a series of default algorithms within all of its logic so that you can create a very efficient starting point for your projections. So you can see that by default, SNAP is contributing to the RSP first, then to the TFSA, and then if there was extra money available, it would contribute it to the non-reg. Once the client retires, it uses the reverse order. So it withdraws first from the non-reg, then from the TFSA, and then from the registered accounts. And this drawdown strategy has been shown through various research from both the CFA Institute and from the Canadian Foundation for Financial Planning to create a very efficient starting point for clients. It's a tax deferral strategy that helps to minimize or defer taxes payable. But you have full flexibility within the software to change either the contribution assumptions or the withdrawal assumptions. One method that we have available to do that is called our cash flow management order. And we can turn that on throughout the projection to provide more customizability. So here you can see the contributions are going to the registered account, then TFSA, and then non-reg. But you could, of course, change that for any 1 year or for any period of the plan. In addition to being able to change the CFM order, I can also customize any of the blue or purple values by changing them for a single year or for a single period. So for instance, with the personal RSP, I could choose to take $20,000 a year starting the first year that they retire, copy that down until age 71 once it converts to a RIF. And then when I run the scenario, Snap is going to adjust all of its numbers around that new request. So now that I'm withdrawing $20,000 a year from the RSP, Snap is taking less out of the non-reg, which is prolonging its life and smoothing out the taxable income. So you have this flexibility available, but once again, that starting point, that base default set of assumptions is research supported and quite an efficient starting point for all of your projections. So that's our second client scenario. Coming back to our list, this was related to having a specific spending target, wanting to know if they're on track, and if not, what they can do. Now we'll move to our third and final client case for today, which is related to a client who has a specific event in mind that they want to plan towards that isn't your more common kind of retirement spending or retirement timing conversation. So in this case, it's a client saving towards a new home purchase and looking to use the first home savings account to help in that process. So we'll go back into Snap one last time. We'll go to our clients list and we'll click Add New Client. This time we're going to be working with a couple who are fairly young and haven't given much thought to their retirement yet. And we'll get frequent requests from users of Snap or prospects of Snap to see whether Snap can be used for planning for younger, early stage clients. And it's very efficient at doing that because you don't have to focus your conversation around retirement. You can do a lot of planning in the early years of a projection and then have Snap default some of the retirement assumptions so that you can give them an idea of where they're headed without needing to have specific assumptions to input into the software. And we'll show you how that will work today. So we're going to be entering in information for Monica Gibson, who was born 1992, currently living in Ontario, and her husband, Eric Gibson, similarly born 1992. Next, I'll click Next and go to the General Settings page. So Monica and Eric haven't discussed their retirement targets just yet, but we're going to leave a default of age 65 just as an illustrative starting point, and we'll run the projection until age 100. We're going to use the same default assumptions for inflation and rates of return. I'll click Next and go to Expenses. Similar to our first case, we're not going to input any target budget or spending in this scenario. We're going to have Snap calculate their discretionary cash flow for the first period of the plan until retirement. And then we're going to have Snap calculate the sustainable spending that would be possible given everything else modeled in the plan. So I'll click Next and go to Incomes. Monica's currently earning $90,000 a year, which we will again index at the general inflation rate. And that's being input as employment, taxable, and RSP eligible. In the top left, you'll see that now because I'm working with a couple, I can toggle back and forth between their pages. So I'll click Eric's name, and that will allow me to enter in his employment income of $80,000 a year, indexing that for inflation. Next, we'll go to Assets, and we'll update the default description to future investments. And we'll change the asset allocation to 30% fixed income, 70% equity. Next, we'll enter in their existing account balances, so $25,000 in a TFSA, $40,000 in an RSP, and $8,000 in a first home savings account. And that's 100% invested in fixed income. Across the top, I can go to each of the registered account tabs to customize their contribution room. So 65,000 in TFSA room, a total of 40,000 in RSP room. And then if we go to the first home savings, I'm going to enter in lifetime contributions to date of 8,000, and that's going to help Snap to automatically calculate their available room and help provide guardrails to prevent over contributing to registered accounts. Next, I'll go to Eric's and enter in similar information there. We have a TFSA with 30,000, an RSP with 20,000, and a first home savings with 8,000, 100% fixed income. And we can go to the contribution room assumptions, 60,000, 50,000, and 8,000. Next, we can scroll down to the real assets section and add in their future home. And that's going to have a purchase price of 750,000 as of age 38. So we can either enter in a specific age or we can enter in a specific date for the transaction. That'll be a joint purchase with no capital gains because it'll be their primary residence. And now that we've added the real asset, we can go into the first home savings account if we want and actually link the account to that future home so that when we buy the home, Snap will automatically make a qualifying withdrawal from the first home savings accounts on the planning page. So this is a fully optional step just to automatically link those transactions together. I'll click next and we can input their future mortgage. They're going to borrow a total of 675,000 at a 5% interest rate and 4,000 monthly payment. We'll go to government benefits and we're just going to leave the default settings in place. So we're going to assume starting at age 65 with the national average CPP benefit. So again, we're using Snap to give us a general direction of where they'd be headed in retirement without needing to focus the conversation too much on that section of the plan. So for both of them, we'll leave the default assumptions in place. Now we can click planning pages and review the projection. So now because we're working with a combined couple, you'll see that there are 3 planning pages available for our use. The combined planning page shows us a summary household level view of the projection. And sorry, I've just realized that I need to add a future start age for the mortgage. So that's going to begin in the same year that they purchase the home. So they're going to get that new cash infusion to purchase the new home with. So on the combined planning page, we have a lot of black values. So you'll see that all of these values are summaries. We can't edit them directly from here, but we can review and understand the projection at a high level in terms of what's going on within the household. To make edits similar to what we did in the last 2 client files, we would click on the individual client planning pages. So here we have Monica, and this page looks much more similar to the plans that we've created already in today's session. We have the ability to contribute into specific investment accounts. So they're going to contribute 10,000 to the RSP each year and 3,000 to the TFSA. And they're going to contribute 8,000 to the first home savings account as long as they can. So I have 2 options here. I can either manually count the number of additional years that they'll contribute and input that myself, or I could actually copy that value down all the way, and Snap is going to stop those contributions once the client has maxed out their available room. So now that I've made these contributions for Monica, you can see that the plan has been updated. We have the qualifying withdrawal in the future year of the purchase. I'll do the same for Eric. So 10,000 to the RSP. 3,000 to the TFSA. And then this time I'm going to just copy down the 8,000 as long as I can. You'll see that Snap enters it initially, but once I run the scenario and Snap recalculates everything, it's going to actually stop those contributions after 4 years. So here we have SNAP has automatically prevented me from over contributing through its calculations. So now we can go back to the combined page and review this to see how they're tracking. So with all of the inputs, the clients have about $95,000 a year of discretionary cash flow available for spending on items outside of the projection. That changes once they buy their home in 2030, so it's going to drop down, and that makes sense because they'll no longer need to pay rent. They'll now have the mortgage, which is being tracked separately in the software. So this remaining 87,000 would be for items outside of the projection on top of their taxes and debt and contributions. And that's going to continue all the way down until retirement. And now what we can do is we can have SNAP calculate their sustainable retirement spending level given their current contribution plan. So if they continue doing this until age 65, then they'd be on track for about 80,000 a year of spending in today's dollars. So roughly in line with what their budget would be once they buy the home. So this has allowed us to have a very detailed analysis around their plan and goal to buy a home while still being able to directionally show them where they're headed further on into retirement. And we again can use the charts to have a conversation and we can interact with those to customize them as needed. And now that we're done creating the projection, we can go into the client report and customize that final client-facing deliverable. So from the report builder, we can select which pages we want to include. So there's the cover page, a disclosure, goals, and we can include or exclude whatever pages we want. So if you don't want to include goal details, you can remove that from the list. If you want assumptions to come first, you can reorder that. Once we're done customizing the report, we can then go to report editor and add any commentary that we want. We can add our logo, customize the background, and then we would be able to review the final report. So those are the 3 client files that we wanted to cover today and show you how Snap can create tailored projections depending on what information your client is coming to you with. We have had to move fairly quickly through the software today, and we haven't been able to cover all of the capabilities. So when you sign up for your free trial, you will have access to our help site immediately and to our customer success team. So if you go to help in the top right, click on Help Center, you'll have the option to review any of our previous webinars. You can also search for key terms if you want to enter in things like an inheritance. And that's going to help you with any of those one-off transactions that you might want to model in the plan. And if you ever get stuck, you can give us a call or send us an email, and we'll be happy to help with the one-on-one screen sharing or whatever is required. And with that, I'm going to pass it back over to Alex for a couple of next steps, and then we'll open it up for questions.
Wow, Steve, thank you so much. As Steve just said, we have covered a lot this hour, but we accomplished even more for our 3 client cases. For Carl, who had no clear goal, we provided him with the peace of mind he needed. For Diana, who had a specific annual spending target, we helped to ensure she could meet her retirement income goals. Initially, she was showing a shortfall, and we created a plan to solve that problem with automated recommendations. And for Monica and Eric, our young couple with a specific life event goal of buying their first home, we helped them to set a plan in place to ensure this major milestone was achievable. But the most important thing here is that we were able to provide highly individualized service. For each of these cases, we were able to meet the client exactly where they were at and give them what they needed. Not to mention, we did it efficiently without any hassle or wasted time. With that, just a few items before we move to the Q&A. A reminder to existing SNAP users that you can be earning free months of SNAP when you send referrals our way. We have recently revamped our referral program to be even more valuable. Referred advisors will now get 50% off their first month of SNAP. If the referred advisor stays with us beyond their 14-day free trial and 30-day money-back guarantee, as the referring advisor, you will receive a 1-month credit to your account. That's an entire free month of SNAP projections. If you are on annual billing, you will receive a $100 credit against your next renewal. There is no limit on how many times you can do this. We have created a new referrals page that you can access from within your SNAP account to make it even easier to leverage this program. Now, for those of you here today not using SNAP, if you're ready to take action now, you can get started with a free trial of SNAP projections. I think we are on the wrong screen here, Steve, but that's okay. Are we able to show the pricing page? Perfect. So on our pricing page, you'll see there are 2 plans for you to choose from as an independent advisor. I'm going to drop it in the chat here now, the link to the page you are looking at. So click on that now so you have that opened up before the session closes out. You can sign up there for your free trial of SNAP projections. If you have any questions about what plan you need, just let us know. The advisor business includes the corporate module and stress testing. That's not something we had time to get into today. It is an add-on for both plans, but it's free during that 14-day free trial. So make sure you enable that right away. Okay, so let's get to our questions. Steve, we had a ton of questions come in throughout the session, so we're probably not going to be able to get to all of them, but we will cover what we can. So we had a few questions about taxes. So I'm going to put this in, I think, to basically 3 different questions all in one. Questions around taxes. Can you show us the charts that are available for taxes and just explain what we can show? Can you show us the advanced settings where we can add in personalized income tax details? And then can you also show us if somebody wanted to, for example, model what they would do with a potential refund? That's so 3 different things.
Certainly. So the first one related to material that you can use for discussions around taxes. The best resource is going to be under the income tax section in the taxable income column. There is a teal blue box with white lines in it that allows you to access the taxable income details table. So this is going to break out the assumptions in the projection related to taxable income. So it would show employment, other sources of taxable income, all of your investment income, so interest, dividends, capital gains. You'd have your registered account deductions, any deductions related to things like the CPP enhanced contributions, or if there was a tax deductible interest on a debt, that's all going to come in here and allow you on a year-by-year basis to really dig into the tax assumptions. In addition to the annual tax assumptions, there is also the tax on estate information. So if I go all the way to the right-hand side of the planning page, you'll see that there's the estate before tax as well as the tax on estate. So if you want to plan around the expected liquidity needed for any of the tax on estate, you can use that resource. And those sorts of resources are also available throughout the client report. So you can find the relevant table or chart that you want to use for your discussions. When it comes to customizing those values, there's a couple options available. The first is to go to scenario setup and then to settings and then portfolio. So here we can customize how much investment income we want of different taxable sources. So whether we want interest income, dividend income, whether that's Canadian or foreign, and then we can also indicate how much capital gains we want to be realizing on an annual basis. So this is how you can customize the taxes related to investment income in your projection. Aside from investment income and customizing that, We also have a page dedicated specifically to income taxes and the calculations in the software. So if I scroll down to the standard section, this is going to show the default credits that are applied to all projections. So those are things like the personal amount, spousal, age, pension, and so forth. If you ever had the need, you could disable that and not apply those credits to a projection, but as a default, those are enabled. You can also customize things like EI premiums, CPP premiums for people who might be self-employed. And then the most customizable section is this additional tool where you can add additional non-refundable federal or provincial tax credits, deductions, or tax benefits for any specific period of the plan. So if a client has an additional tax credit, such as a disability tax credit, you can enter those values here, and then that will apply it to the relevant period of the plan that you'd like it included for. If a client has a specific year where they're going to have a large tax deduction, you can enter that, and that will offset some of the taxable income, and that will also reflect in the taxable income details table that we looked at initially. In terms of modeling refunds and having discussions around those, what you can do is you can see the total taxes payable with and without a contribution being made. So in this case, the total tax payable for Monica in 2024 with a $10,000 RSP contribution is going to be $12,465. If we remove that contribution and rerun the scenario, we'll be able to see the total taxes payable if she were to not make that contribution. So here it's 15,580. So the difference between those two values would be your refund, and you can have a discussion around what the client would like to do with it. The other option is to use the marginal tax rate and apply that to the contribution as a proximity for the total refund that they would receive. And then you could have a discussion about making that contribution either into the RSP once it's received, and you could increase, the contribution to be 13,000 instead of just 10, and that would assume that they're going to reinvest the refund once received. So those are some of the options available for tax conversations.
Perfect, Steve. Thank you. And a few questions surrounding the decumulation order. Can you just quickly revisit what the defaults are and the options we have to control that?
Yeah, so the defaults for contribution, so in the accumulation phase where there's a surplus, SNAP will contribute first to the RSP, then to the TFSA, and then to the non-registered account. When it comes to withdrawals in retirement, it would be the reverse of that. So it would withdraw first from the non-reg, then from the TFSA, and then from the registered account. If I wanted to change that, I could click on the order, update the order. So maybe I want to use registered money first because the client has a shorter life expectancy and they want to get rid of the tax bill that's expected on their estate. So now what I've done is run the registered non-reg TFSA, and you can see that there's no longer any money coming out of the TFSA or non-reg until the registered money is fully depleted. So we're using registered all the way until age 88, and only then do we turn to the non-reg and TFSA assets for use. So that's how you can customize using the cash flow management order, or you can, as we did earlier, you can change the dollar amount in any of these accounts to take a dollar amount out, or you could just set the contribution to 0 and say, don't use the TFSA. I want to leave that entirely for the estate. So you have full customization and control over those settings.
Perfect. Thank you so much, Steve. Well, everyone, just looking at the clock here, we are essentially out of time. I know there are many more questions that we have not had the opportunity to answer. I will follow up with everyone via email. There's a very brief exit survey that's going to pop up on your screen here in a moment when we end, and we would really appreciate if you could take a moment to provide us with some feedback and let us know what you would like to see next time. So thank you so much for being here with us today, and I hope this has been a valuable session for all of you. A few emails will be coming out with next steps, as well as the form to fill out to get your CE credit and information for anyone who would like to get set up with a free trial of SNAP projections. Enjoy the rest of your day, and we are looking forward to continuing the conversation. Bye for now.